That's the didn't like my clicking. So we have a lot of earnings coming through here. So you get a psychological shift if we get some earnings on the stocks. Going back to the S&P, here is a quarterly on here, and basically it was the first quarter reversal. We need to clear the high on here for this quarter into June. I'm not. We may get something for. Into the summertime rally here. Friday's non-farm payroll was perfect for this time of year to get interest rates to come down to allow people to buy homes. Typically, interest rates do drop until June 30th, and then they begin to spike back up again. As you know, I'm looking for some sort of recession going forward, and also North American drought. The market is long in the tooth. In my eyes, I look at the kitchen cycle that used to be 40 to 44 months for a business cycle, but lately we've been extending it 8 years. The Federal Reserve is pulling money out of the economy, so interest rates are driven up because of there's a shortage of cash. People are willing to pay up. So this is all a time thing here. If we do get a drought over the summer and food prices spike, that kind of thing, then the Fed may come back in. We have had we've had low inflation for a while because of technological advances. Here are the patterns again on the top: the correction of 2000 to 2002, and then 2007 to 2009. There are 8, and then the move up here. So my biggest concern, of course, is that this is coming, something from the 1930s, the low of, that color, the low here from the Great Depression. Well, after the Great Depression, the market went up for 25 years before the next recession. So I'm not assuming so. We're having fewer children and things of that nature, but if it does come back, my biggest concern is that this is a 5 wave off the bottom. We have the baby boomers and everything come through, and then wave 4, and then we're working on wave 5. And we haven't cured the depression. That's just where we'll just say wages are stagnant, and if the credit tightens up, at some point, things are going to catch up to the whole wage deal. Everything is relative. You can see here the red on balance volume on here too, but you can see that volume. They didn't list volume here. All right, so continuing on. Okay, so we get a little shorter period of time here on a monthly here for April. We may be making a triangle on here, and then carry on forward. The market did come back 10%, which is minimum. And then Friday's after close action, maybe kind of telling that they came in and the pros took on inventory, because you may have an ABC correction here and then you just continue higher on here. If we have 3 months of decent earnings, lower interest rates, things of that nature. I think the dollar is going to start working its way higher. The grain embargo of 1980 was also during a drought, and prices just went bonkers, but then we had to squelch the economy with 20% interest rates. But for right now, like I said earlier in the week, Wednesday, we did we opened at the low and then moved higher. Here is bullish percent. I'll do another video on this. Bullish percent of the S&P 500 divided by the volatility of the S&P 500. And you can see back here where we had the China incident in August, and then we had another pullback here. I can't recall what that was. But basically, to give you a rough idea of where the market was at the top up here, post-election to where we're at now, just a relative. I don't know if we could do this weekly. Give you an idea, at what point. But any new lows in any of the stuff, we're going to get a heck of a move to the downside. It'd be a wave 3. This is going to be precipitous selling. You can see the spikes here, 2008, and